Welcome to this explainer. When you look at the global stock market today, it's so easy to get totally lost in the flashing tickers, the crazy financial jargon, and those high-frequency algorithms. But if you strip all that noise away, what you're really looking at is actually pretty simple. It's kind of like a giant vegetable market, except instead of trading tomatoes and carrots, we're trading ownership stakes in real businesses. It's the ultimate engine for funding human enterprise, a place where capital literally meets innovation. Today, we're going to completely demystify the actual mechanics of how this whole system works, taking you from its ancient origins all the way to our modern digital networks.
Okay, let's dive into this. Here's the cognitive roadmap we'll be following today to wrap our heads around the seemingly complex world of financial markets. We'll start with the birth of stock exchanges, then look at why they actually matter. After that, we'll break down how trading really works, compare auction to electronic markets, and finally look at global access and strategy.
Right, let's kick things off with Section 1, the birth of stock exchanges. Because raising capital, well, as we'll see, that is a centuries-old business solution. So, the modern market, it actually wasn't born on Wall Street. No way. It started in Amsterdam way back in 1602. The Dutch East India Company, or the VOC, had a massive problem. Ships were incredibly expensive to build and send across the world. Their brilliant solution? They just divided their capital into shares that the general public could buy. It was literally the very first organized secondary market for shares. Fast forward a bit to 1792, and you've got brokers signing the Buttonwood Agreement, which created the New York Stock Exchange. And then, jumping to 1971, the NASDAQ launches us straight into the digital era. But here's the crazy part. From wooden sailing ships to fiber optic cables, the core concept of trading ownership remains exactly the same.
Moving to Section 2, why stock markets matter. Why did these exchanges become the absolute backbone of our global economy? But why did this Dutch invention stick around to run the whole global economy? Basically, exchanges serve three absolutely critical functions. First up, raising capital. Through initial public offerings, or IPOs, companies can fund massive expansions, build out research labs, you name it. Second, and this is absolutely crucial, corporate governance and scrutiny. Public companies are subject to really rigorous financial reporting. This deep market transparency is what actually protects investor interests. It essentially forces management to stay honest. And third, economic efficiency and liquidity. Look, instead of your cash just sitting idle under a mattress and losing out to inflation, exchanges allow your capital to actively fund economic growth. It gives you a place to grow your cash efficiently while keeping your wealth highly liquid. All right, Section 3. How trading actually works. Now, what's really interesting about this next part is getting under the hood of an actual trade. Trading from the outside can seem totally chaotic, right? But the actual life cycle of a stock trade, from the investor to the final transfer of ownership, is a highly regulated, very logical flow. Step 1, you, the investor, place an order through your digital broker. Step 2, the exchange's automated system steps in and instantly searches the marketplace, looking for a buyer or seller willing to meet your price. And then Step 3, once that match is made, a clearinghouse executes the trade and the ownership is transferred. Bam! Almost instantaneous. But wait, who actually guarantees that Step 3 happens safely, at the speed of light? Enter the clearinghouse. Think of them as the highly trusted bouncers of the financial system. They literally stand right between the buyers and the sellers, absolutely guaranteeing that the transaction executes perfectly, even if one of the parties defaults. They are the unsung heroes, acting as the independent intermediary, keeping the whole market safe and orderly for everyday folks like us.
Now, when you actually go to buy shares and place that order, you usually have to make a choice. A market order means you're saying, hey, I want this stock right now at whatever the current price is. You are totally guaranteed immediate execution, but you don't get to control the exact price. A limit order, on the other hand, flips that entirely. You dictate a highly specific price target. The trade only happens if the stock hits your exact number. So you get total price control for sure, but the trade-off is you risk the trade never actually happening at all if the price doesn't hit your target.
So, how is that current market price actually determined in the first place? It's all through this real-time battle called price discovery. It's pretty simple. The bid is the highest amount a buyer is willing to pay, and the ask is the lowest amount a seller will accept. When those two numbers finally meet, boom, a trade executes. It's the ultimate real-time reflection of supply and demand dictating stock prices all day long.
Let's move to Section 4, auction markets versus electronic. Let's see how this builds and compare the two giants of the U.S. market. All right, let's contrast the two structural powerhouses of the system. First, you have the New York Stock Exchange, or NYSE. This is a classic auction market. We're talking a physical trading floor, human market makers maintaining order, and it's generally known for favoring established, blue-chip companies that offer a lot of stability.
But then you have the NASDAQ. They completely rewrote the rules. Operating 100% electronically without any physical floor, it uses a massive network of computers, all competing to provide the best prices. Its tech-focused roots make it the absolute go-to for modern, hyper-growth enterprises. And honestly, the modern, data-driven electronic trading environment is just brilliant. Think about massive data displays and digitized infrastructure. This cutting-edge technology allows for near-instantaneous trade execution, creating incredibly high liquidity. While traditional auction markets maintain that classic stability, electronic exchanges have completely revolutionized rapid trade execution, pushing the absolute boundaries of speed and efficiency.
Which brings us to Section 5, Global Access and Strategy. Let's bring these concepts globally and directly to your wallet.
Today, getting involved in the market is a truly global thing. For instance, platforms like the Pakistan Stock Exchange, the PSX, allow investors to tap directly into regional growth. And what's really fascinating here is that in markets like this, we see the integration of the profit and loss sharing, or PLS model. This is super important because it ensures investments align perfectly with Islamic ethical finance principles. Instead of relying on fixed interest, the risks and the rewards are equitably shared. But really, no matter where in the world you invest, the fundamental balance remains exactly the same. You are seeking rewards like capital appreciation and dividends, while simultaneously navigating the very real risks of market volatility and capital loss.
So the crucial point is, because of those risks, you absolutely cannot just guess. You need a strategy to achieve long-term success. That's where things like diversification come in, basically spreading your bets out so one bad earnings report doesn't wipe out your whole portfolio. Then there's the buy and hold approach, which is all about ignoring the daily emotional panic and focusing on long-term growth. Dividend investing targets companies that consistently share their cash profits right back with you. And finally, value investing. This means doing the deep research to find fundamentally great companies that the market has just temporarily mispriced.
At the end of the day, the stock market is far, far more than just some casino of flashing numbers. From those maritime merchants back in 1602 all the way to the lightning-fast, ethical, and electronic networks of today, it remains a centuries-old engine of wealth generation. So I'm going to leave you with this to ponder. In a world where your cash can either sit completely idle, losing value to inflation, or be put to work funding the massive innovations of tomorrow, will your capital remain untouched, or will you take an ownership stake in the global economy? Thank you so much for joining me on this explainer, and keep it